In this lecture, we will cover the CFA Level 1 reading on futures, markets and contracts. Here are the 6 sections in this reading. A futures contract is an agreement between two parties in which one party, the buyer, agrees to buy from the other party, the seller, an underlying asset or other derivative at a future date at a price agreed on today. This will look exactly the same as what you saw with forward contracts, and the fact is that at a high level, forwards and futures are both similar in the sense that we are getting into a contract at a certain point in time, let's say time 0, about buying or selling some asset or some other underlying at a future point in time. So it is a commitment from both sides. As with forward contracts, the party which is getting into the contract to buy is called the long party, and the party which is getting into the contract to sell is called the short party. Having said that, you need to recognize that there are several differences between forward contracts and futures. Here is a list of attributes related to forward contracts. Forward contracts are private contracts. They are traded over the counter. If you recall, we discussed the concept of a network of dealers who interact either with each other or with end users. All those transactions happen in an over-the-counter market. They are unique contracts which are established between the two counterparties. There is some default risk or credit risk. There is no margin. When we get into a forward contract, we do not have to pay any money, and there is very little regulation associated with forward contracts. With futures contracts, the big thing is that they are exchange traded. So they are well-defined exchanges all over the world. Examples of futures exchanges include the Chicago Mercantile Exchange, the New York Board of Trade, and so on. Futures contracts are standardized, as we'll discuss on the next slide. Futures contracts are guaranteed by the clearinghouse. You can think of the clearinghouse as a function or a process within the exchange. And because of other items such as marking to market and daily settlement, there is effectively no default risk associated with futures contracts. There is a margin requirement, which means that if you want to get into a futures contract, you need to post a certain amount of money, and futures contracts are regulated. From a testability perspective, it is quite important to understand the differences between forward contracts and futures. When we talk about a futures contract, the price is the only term which is set by the two parties. The exchange sets all other terms, and this standardization increases the liquidity of a futures contract. Let's make sure we understand what we mean by standardization. If you take a particular futures contract, such as the futures contract for cotton, the exchange will define the underlying commodity. Exchange will define whether this contract is a cash settled contract or whether there needs to be delivery. What is the amount? For example, the amount might be 1,000 pounds of cotton. The currency, which might be US dollar. Agreeing on cotton is one aspect, but what grade of cotton? If this is a deliverable contract, then what is the delivery month? What is the last trading date? What is the tick size? The tick size is the minimum amount by which the contract price can change from one transaction to another transaction, the same concept as what we have in securities markets. So this illustrates that futures contracts are standardized, they are defined by the exchange, and because of this standardization, it makes it easy to sell these contracts from one party to another, and hence the liquidity is relatively high compared to forward contracts. Futures transactions are reported to the exchange and the regulatory authority which oversees the exchange. So the regulator and the exchange know everything about transactions, which includes the price, the counterparties, when the transaction takes place, and so on. The price is made public. So while the public doesn't know exactly who is engaging in a particular transaction, but the public is aware of the prices involved. The exchange guarantees the performance of the other party through the clearinghouse. In a sense, the clearinghouse becomes the counterparty to each transaction. So let us look at exactly what this means. If you have two parties, A and B, in the context of a forward contract, these two parties engage with each other. Let's say A takes a long position, B takes a short position. When we talk about a futures contract, then effectively what happens is we might still have A and B, but now we have the clearinghouse in the middle. If A is taking a long position, then the clearinghouse takes a short position. From A's perspective, the counterparty effectively is the clearinghouse. B takes a short position and the clearinghouse takes a long position with B. So again, for B, it is the clearinghouse that is taking the opposite position. For both A and B, the clearinghouse is the counterparty, which essentially guarantees that there will be no default and therefore there is essentially no credit risk. Coming now to futures trading. Traditionally, futures trading happens through what is called pit trading, where there is a space or a floor on the exchange and traders come into this physical space and shout out their orders. All they really need to say is what price they are willing to buy at or sell at. In many countries though, pit trading is giving way to electronic trading. As we've discussed before, a long position is a position where a trader is getting into a contract to buy the underlying, and a short position is a position where the trader is getting into a contract to sell the underlying. With futures contracts, typically the profit or loss is settled on a daily basis. This happens through a process called daily mark-to-market. It is possible to close an existing position through a process called offsetting, and we will see an example of this on a subsequent slide. Here is a very simple futures trade. Let's say we have a July cotton futures contract which calls for the delivery of 50,000 pounds of cotton in July, and the futures price is $1 per pound. This means that the contract value is 50,000, which is the quantity multiplied by the price. So the contract value is 50,000. The long is obligated to buy this many pounds in July, which is the delivery month, at this particular price, and the short is obligated to sell this amount at this price. Let's look at an example of offsetting. In January, you purchase a June futures contract on the KSE 100 index. So let's say this is contract 1, you take a long position and this is the underlying. You decide to close this position in March. How can you do this? One way of doing this is to take an opposite position. So in March now, you take a short position with the same underlying and with the same maturity or expiration date. From the perspective of the clearinghouse, you first had a long position, now you have a short position. So effectively, you don't have a position anymore because the long and the short cancel each other out. So this is called offsetting, where two contracts offset each other and you effectively then close your position. John is a futures trader. In March, he takes a short position. So here now we have a short position expiring in August. 2 weeks later, he decides to close out this position. How can this be done? All he needs to do then is take a long position with the same underlying and expiring at the same point. This then means that his position is offset or cancelled out. A silver futures contract requires a long trader to buy 5,000 ounces of silver. A trader buys one December futures contract at a price of $23 per ounce. What is the maximum loss that this trader could have? This illustrates an important point now. If a trader is taking a long position, he is happy or he benefits if the price goes up, and he is sad if the price goes down. Now, the maximum amount that he can lose is if the price comes down to zero. This is unlikely, but if the price comes down to zero, that is where he will have the maximum loss, and that maximum loss is going to be 23 multiplied by 5,000. Another trader sells one December silver futures contract. What is the maximum loss? Now, this other trader is taking a short position. With a short position, he wins if the price goes down and loses if the price goes up. So, since he is short, his worst case scenario is that the price keeps going up. So, his loss is unlimited. Coming now to the clearinghouse margins and price limits, and I think this is perhaps the most testable aspect of this reading. When taking a long or short position in a futures contract, a trader must deposit sufficient funds to meet the initial margin requirement. The money that the trader deposits can be thought of as a down payment. It can also be thought of as collateral or a performance bond. The margin requirements are set by the clearinghouse and are based on price volatility. If the account falls below what is called the maintenance margin, the trader must bring the balance back to initial margin the next day. The difference between the initial margin and the maintenance margin is called the variation margin. The settlement price, and this is a term that you will keep seeing, is the average price of the last few trades in a given day. So if we have several trades happening over here, rather than simply take the last trade or the price of the last trade as our settlement price, what we do is look at the last 3 or 4 trades and take their average. That average represents the settlement price. Now let me elaborate on 1 or 2 points here. Margin requirements are set by the clearinghouse and are based on price volatility. This is different from security markets where the margin requirements are set by the regulator, and in fact there are several other differences between the concept of margin that we discuss here and the concept of margin in securities markets. Those differences will be discussed on a later slide. Here I want to emphasize that the margin requirement is set by the clearinghouse. Typically the margin requirement is 10% or less, and if the price of our underlying asset is very volatile, then the margin requirement will be relatively high, which will be maybe 10%. If the price volatility is low, then the margin requirement might be much lower than 10%. To understand these concepts, let's go through an example, and this example is based on Exhibit 1 in the curriculum. Consider a futures contract in which the current price is 100 and the margin or the initial margin requirement is 5. This means that if you go long or short one contract, then you need to post $5. The maintenance margin is 3 and you go long 10 contracts. So let's work through the numbers now. Day 0 means start of day 1. Since you are going long 10 contracts, you deposit 50. 50 is 10 contracts multiplied by the initial requirement of 5. So you put in 50. The settlement price which is given is 100. So ending balance for day 0, which again means the start of day 1, is 50. At the start of day 1, you don't need to deposit any other funds. You've already put in the 50. Let's say that the settlement price at the end of day 1, so these are end of day prices, end of day one, the price goes down by 80 cents. Since you are long, a price decrease is a loss. The overall loss is 8, and the ending balance in your account is down from 50 to 42. We need to compare this number with the maintenance margin. The maintenance margin is 10 times 3. 3 is coming from here. 10 is the number of contracts. So our maintenance margin is 30. We are above 30, so we are fine. End of day 2, our beginning balance is still 42, but the price goes down a lot. The price change is 3.2. We lose 32, and the ending balance now comes down to 10. This is less than the maintenance margin, so we need to top back up. As indicated on the previous slide, we need to deposit enough funds so we come back to the initial margin of 50. Our balance was 10, we add 40 and get back up to 50. And then the rest of the numbers should make sense. We are following the same pattern that I have discussed. Every time the price goes up, money is put into our account. If the price goes down, then money is taken away from our account. If we fall below the maintenance margin, then we need to top back up to the initial margin. I want to emphasize a few points over here. Notice that we are doing a daily mark to market, which is also expressed as daily settlement. So marking to market or daily settlement are similar terms. What are the advantages of doing this? The big advantage is that if a trader is losing, then the losses are settled on a daily basis. We don't wait for a situation where the trader gets into a very deep hole or owes a lot of money, because if that happens, then the chances of credit risk or credit default become quite high. So we just settle on a daily basis before losses become too large. On the flip side, then, gains are also credited or received on a daily basis. That's one point. The other point is that by having the margin requirement, so the clearinghouse requires that both parties put in money. And as mentioned before, the money that is put in can be thought of as collateral. It could be thought of as a performance bond. It could also be thought of as a down payment. So if somebody is putting in 50, that could be thought of as a down payment for the eventual amount that the trader will need to pay for the asset on the final or on settlement date. So there are different interpretations, but the mechanics of how the process works are shown over here, and hopefully you recognize the fact that through this process, credit risk is practically eliminated. On this slide, we are showing the beginning balance and the ending balance for the short party. Like other derivatives, futures contracts are also a zero-sum game, which means that if one party is winning, then the other party is losing by the same amount. So this is more or less a mirror image of what you saw on the previous slide. Now I want you to do example 1 from the curriculum, which is using the same concepts that we've discussed over the last 2 slides, but the numbers are a little different. I have alluded to the fact that margin is treated differently in securities markets and futures markets. Not only is margin treated differently, the whole concept of margin is different. In securities markets, and we studied this under the equity segment of the course, the margin indicates how much an investor can borrow. So when an investor opens a margin account, and let's say that in the environment where the investor is operating, there is a 40% initial margin requirement. This means that the investor must put in at least 40% of his own money and can therefore borrow 60%. So a margin requirement of 40% is an indication of how much leverage the investor can have. A maintenance margin is an indication of how much minimum equity an investor must maintain. So if the maintenance margin is 25%, then this means that the ownership percent or the equity that the investor has in the underlying asset or in the asset over here must be at least 25%. And if you don't quite remember this, you can go back to our lecture on this subject in equity. If the equity or the percentage ownership of the investor falls below 25%, he needs to come back to the maintenance margin level or 25% level. He does not need to go back up to the 40% level. With futures markets, the margin indicates how much the trader must deposit as collateral or down payment. So if the margin requirement is $5 per contract, this is an indication of how much money the investor must actually put in. If we have a 10% initial margin and the price is 100, this means that the investor must put in at least $10. And we've talked about the fact that this $10 can be thought of as a collateral or a down payment or a performance bond. If the balance falls below the maintenance margin, then the trader must get back up to the initial margin. From an exam perspective, I think this is fairly testable, so make sure you know these differences quite well. Next, we come to price limits. Price limits are exchange-imposed limits on how much the contract price can change from the previous day's settlement price. A few high-level remarks before I move on. Price limits are set by some exchanges, not by all exchanges. And also price limits will be on some contracts, not necessarily all contracts. Now let's say that a given contract settled yesterday at $30 and the price limit for that contract is set at 4. A limit move is where there is a price freeze at one of the limits. So for example, if the previous day's settlement was 30, and for some reason the price has gone up, so traders now want to trade at 36. The price will go all the way up to 34 and then the price will freeze because traders want to trade at a higher price. So this is a limit move. Specifically, if the limit move is up and we are stuck at the upper limit, then we say that we have a limit up situation. So price is stuck at the upper limit. If the price falls and we are stuck at 26, then this is called a limit down. So price stuck at the lower limit. Limit locked is a situation where transactions cannot take place because the price would be beyond the limits. Now, if we are either at limit up or limit down, then possibly the next day the prices will come back into the proper range and transactions can take place. If we are stuck where this is just not happening, then the exchange can either change the price or change the limits. So exactly how the exchange deals with this is up to the particular exchange. You do not need to get into too much detail at this stage. Section 4. Delivery and cash settlement. When an exchange designs a futures contract, it specifies whether the contract will terminate with delivery or cash settlement. Futures traders can close out a given position by taking the opposite position before expiration. And to some extent, we've talked about this before, but the closeout that we'll refer to here is a closeout that happens shortly before expiration. We are now going to demonstrate that a delivery of the underlying or cash settlement or a closeout are equivalent, and this is going to be based on material presented in Exhibit 2 in the curriculum. But we need to keep in mind that because of the inconvenience of dealing with a physical commodity, most parties will prefer cash settlement or a closeout. So let's take a look at this example. Consider a futures contract which expires on 21st August. A trader takes a long position on 19th August and the settlement price or the price over here is equal to 40. So he enters the contract when the contract price is 40. On 20th August, one day later or the end of the next day, the settlement price is 42. Now, regardless of whether this is a cash settlement or a delivery, at the end of 20th August, there is going to be a profit of $2 for the trader. Then let's say that at expiration, the price or the settlement price is 43. And we will look at the three different scenarios. Let's first look at the delivery scenario. If this were a delivery, then the trader would get the underlying asset for 42 because that was the settlement price on the previous day, and then he could go to the market and sell at the market price of 43 and make a profit of 1. That profit of 1 added to $2 from the previous day would mean that he would make an overall profit of 3. Next, let's look at cash settlement. If this is a cash settled contract, then his profit over here is going to be 1. The exchange will credit 1 to his account. He already had 2 from before. So again, his overall profit will be 3. And close out now. Let's say that this is a delivery oriented contract, but the trader doesn't actually want delivery. What he can do is shortly before the day closes, where the price is now still close to the settlement price, the trader can take an opposite position, which would be effectively a closeout. When he takes a opposite position, he will make a profit of 1. That added to the 2 from here will mean that his profit again is 3. So note that regardless of the approach, the overall profit remains the same. Here I just want to clarify one point. The last scenario that I talked about was a closeout. So initially he has a long position. This long position implies that he has the right to buy the underlying for 42. When he gets into a short position or sells or gets into a selling position, he is selling at the price of 43. And the fact that he can buy for 42, sell for 43 gives him the profit of 1, and the overall profit when combined with $2 from the previous day is 3. Delivery and exchange for physicals. Contracts designed for delivery may have features that complicate delivery. Delivery may occur over several days or any day during a business month. A short may have an option to decide where to deliver, and keep in mind that delivery options are valuable for the short party. So if you have a July cotton contract, the delivery may occur on any business day in July. It might be that the short might also have an option in terms of what particular city or what particular location to deliver at. And keep in mind that these delivery options are options which the short party has, and anytime a party has options, that is a positive. Another scenario is an exchange for physicals, also called EFP. In an exchange for physicals, the long and short arrange an alternative delivery procedure. The long and short settle outside the exchange's regular procedure, but report the transaction to the exchange. So as long as the long party and the short party engage in some transaction outside the rules or outside the boundaries of the exchange, that is okay, as long as both these parties report the transaction to the exchange. A few words on futures exchanges. This item is not explicitly mentioned in the learning objectives, so I don't think it's overly testable, but I'll still summarize what is stated in this section of the reading. A futures exchange is a legal corporate entity whose shareholders are its members. The members act as flow traders, and the term used for them is locals, or as brokers, and here the term used is futures commissions merchants or FCMs. Traders can have several different trading styles. We have a style, or those who are called scalpers hold positions for very short periods, making money on the bid-ask spread. Day traders hold positions for longer but close by the end of day. Position traders hold positions open overnight. If you want to take a look at some of the world's largest futures exchanges, then open up to Exhibit 3 in the curriculum. Section 6, Types of Futures Contracts. Very simplistically, a futures contract is identified based on the underlying. In this particular section, we will focus on financial futures, but broadly speaking, we can either have commodity futures or non-commodity or financial futures. Exhibit 4 gives a list of some of the most active commodity futures and some of the most active financial futures. The specific financial futures that we will look at are short-term interest rate futures contracts. We will focus on Treasury bill futures and Euro-dollar futures. These are more or less similar. Then we will also briefly look at intermediate and long-term interest rate futures contracts, stock index futures contracts, and currency futures contracts. Treasury bill futures contracts are based on 90-day $1 million par value US T-bills, and they are cash settled. If you recall from before, futures contracts are standardized. Everything other than the price is defined by the exchange, and it is part of that standardization that we have this particular futures contract. So notice it is part of the standardization that we define that this is a 90-day T-bill, we define the par amount, and we are defining, or the exchange is defining, that this is cash settled. The price is quoted using the IMM index, and the IMM index is 100 minus a rate. This rate is the discount rate, and we have seen the bank discount yield or bank discount rate calculated in quantitative methods, in corporate finance, and also in fixed income. So if we have a discount rate of 6.25%, remember this is a bank discount yield, then the IMM index will be 100 minus 6.25, which is 93.75, and the actual price is 984,375. Now I want to see if you can come up with this particular number, and the hint is that you need to use the formula for the bank discount yield. Here is what you need to do. The bank discount yield is equal to the discount. This is the actual dollar discount at which the instrument is selling, and this is the discount relative to the face value or par value. So discount over face value into 360 divided by T. The discount is what we need to calculate. The bank discount yield of 6.25% is given here and expressed in decimals. The face value or par value is 1 million into 360 over T. T is 90 because we have a 90-day T-bill. When you do the calculation, you should get D equal to 15,625, and the price of the instrument, or the actual price, is 1 million, which is the par value less the discount, and you should get 984375. So that is how we get this particular number. Now the interpretation of what we are looking at here is the following. If a T-bill futures contract is being traded and the quoted price is 93.75, and you get into this contract, what that means is that at expiration of this contract, you will have the right to buy this instrument, a 90-day 1 million US T-bill, for this particular price. And this contract might be expiring in 60 days. So if you are at day 0, the contract might expire in 60 days. You are getting into a contract to buy the underlying instrument on this day. And then the underlying instrument is a 90-day T-bill. Now I want you to do the following. If the next day the price goes up by 1 basis point from 93.75 to 93.76, then what is the price? If you do the same calculation, where you now, instead of using 93.75, you are using 93.76, the rate now is different. So it is going to be 0.0624, which means that the new discount that you will calculate is different, and then the price, which would be 1 million minus the discount, will be different. So let's call that P2. What you should get is 984,400, and you will notice that there is a difference of $25 between these two prices. What that means is 1 basis point is equivalent to $25. So if the IMM goes up by 2 basis points, that means that the long party has gained by $50. As a general point, the minimum tick size is 1/2 of a basis point, which is 1250. T-bill futures are important to understand from an exam perspective, but in the real world, they are not that actively traded anymore. Euro-dollar futures are now considered much more important, and they are more actively traded relative to T-bill futures. Euro-dollar futures are based on LIBOR, which, as we have discussed in the previous reading, is the rate for high-quality private borrowers and is therefore less influenced by US government policies. The US government policies have a direct impact on T-bill rates. The calculation for Euro-dollar futures, however, is exactly the same. So Euro-dollar futures are also based on 1 million notional principal, and there is a 90-day LIBOR, which is underlying rate. These contracts are also quoted as 100 minus an annualized 90-day LIBOR in percent. They are cash settled. 1 tick, however, is 1 basis point. There is a slight complication which you just need to be aware of but don't need to get hung up with, which is that LIBOR is an add-on rate, but it is treated here like a discount rate because we have 100 minus a annualized 90-day LIBOR. Now this creates slight issues, but you don't need to get into them. As far as you are concerned, if you get a question related to Euro-dollar futures or T-bill futures, all the calculations are similar. Next, we come to intermediate and long-term interest rate futures contracts. This section of the curriculum just focuses on US Treasury bond futures, which are based on the delivery of a $100,000 par value US Treasury bond with any coupon, but the maturity is at least 15 years. So you can see from this description that we are talking about a wide range of bonds, because there will be bonds with different coupon rates. There can be several maturities beyond 15 years. The price is based on points and 30 seconds. So you might have a price that is something like 101 and 1830 seconds, or this might sometimes be written as 101 and 18. 18 over 32 is simply a fraction which needs to be converted into a decimal when you do your calculations. There is a question in the curriculum also which is based on US Treasury bond futures, where they have used these fractions. And we go back to class 6 maths, where the fraction can be converted into decimals, and then all the calculations are exactly like what you have done in other places. Since we have a range of bonds involved over here, the short has the option to deliver one of several bonds. Now, to deal with this challenge, the exchange defines a standard or hypothetical bond with a particular coupon rate, for example, and a particular maturity, which has a conversion factor of 1. And then all bonds which are different in some form, either different coupon rate or different maturity, or different both in terms of coupon rate and maturity, they will have a conversion factor which is different from 1. And it is these different conversion factors which will be used in our calculation. The purpose of this conversion factor is to put all bonds on equal footing. In level 2, we will do questions where we actually use the conversion factor in our calculations. At level 1, you simply need to recognize that this concept exists. Related to this concept is the fact that there is going to be a particular bond that is the cheapest to deliver, and the cheapest to deliver bond is the one where the amount received for delivering the bond is the largest relative to the price of the bond in the open market. So again, at this stage, you simply need to understand this definition. Stock index futures contracts. We can have futures contracts based on major stock indices such as these ones. One of the most popular stock index futures contract is based on the S&P 500, and it is called the S&P 500 stock index futures contract. This is cash settled and has an implied multiplier of 250. Now the example over here will illustrate the usage of this multiplier. The price that is quoted is based on the actual price of the index or the value of the index. Let's say that the S&P 500 stock index futures contract is quoted at 1240. The next day the price goes up by 1. If you are long on one contract, the multiplier on this contract is 250. What this 250 means is that on one contract, if the price goes up by 1, then the gain is 1 times 250, which is 250. If you are long 10 contracts and the price goes up by 1, then your gain is 10 into 250, which is 2500. If you are long on 10 contracts and the price goes up by 2, then the gain is going to be 10 into 2 times the multiplier of 250. So the multiplier is quite easy to understand. It does exactly what it says it does, which is to multiply by that particular number. With other stock index futures contracts, we might have other multipliers. So for example, there might be a multiplier of 50 or 100. And as long as you know that multiplier, it is easy to use. Currency futures. In the United States, the primary currencies on which trading occurs are the euro, Canadian dollar, Swiss franc, Japanese yen, British pound, Mexican peso, and Australian dollar. So we will always have two currencies involved. In the US context, obviously one currency is the US dollar, and then the other currency is one of these major global currencies. With a currency contract, the currency needs to be defined. So the other currency might be the euro, for example, and the amount needs to be defined. So you can have a currency contract, for example, for 125,000 euro. Note that the currency is defined and the quantity is defined. This will be quoted on a per euro basis. So if it is quoted at 0.8555 per euro, that means that you are getting into a contract to buy 125,000 euro at this price per euro. Now, if the price goes up to 0.8556, then the party that is long on the euro, which means the party that is getting into the contract to buy the euro, will gain. How much will it gain by? This difference. So you can do the difference between 0.8556 and 0.8555. So you take that difference and multiply by the quantity, which is 125,000. This will tell us the gain to the long party on one contract. If we have 10 contracts, then we'll simply multiply this number by 10. That brings us to the end of this particular reading. I'll summarize the most important points. You need to understand the similarities and differences between forwards and futures. Both forwards and futures are commitments. So both parties agree on a given transaction in the future, and then both parties are bound to fulfill the commitment. The difference is that forwards are private contracts which are traded on the over-the-counter market. We have a network of dealers who engage with each other or engage with end users. Futures contracts are standardized, which makes them more liquid. Futures contracts are exchange traded. The credit risk is essentially negligible with futures contracts, whereas with forward contracts we do have credit risk. So those are the major differences. With futures trading, you need to understand the concept of the clearinghouse. The clearinghouse ensures that any party that needs to engage in a futures transaction has to put in an initial margin. That initial margin can be thought of as a security bond, or it could be thought of as a deposit. There is a maintenance margin, which means that if the balance comes below the maintenance margin, it needs to be topped back up, or the account or the balance needs to be brought back up to the initial margin. We have daily mark-to-market or daily settlement, which means that at the end of every day, any losses are settled and any gains are credited to the account. This helps minimize credit risk. As I've already discussed, the concept of margin in security markets is very different. When we talk about a margin in security markets, this is an indication of how much money an investor needs to put in and how much money an investor can borrow when buying a particular asset. With futures markets, margin means something very different. The margin is either a deposit of sorts or it is a form of collateral. We talked about price limits, where in certain exchanges, on certain contracts, we might have a price limit which indicates the maximum amount by which the price can change in a given day. Then we talked about several different types of futures contracts. The T-bill and euro-dollar are similar from our perspective, where the underlying is 1 million worth of a 90-day instrument. The prices are quoted using the IMM index, which is 100 minus the rate. Then we talked about stock index futures, which are futures where the underlying is an index. The main point here is the concept of a multiplier. And finally, we talked about currency futures. As always, I want you to read the summary, review the learning objectives. There is just one example, so do that. There are several good practice problems. Not all of them are multiple choice, but I still think they are good. So work through all the practice problems in the curriculum and also do practice problems from other sources. That is it.